Welcome to the deep dive. Today, we're taking a fascinating plunge into the latest from Roper Technologies, tickers ROP.
Yeah.
We've got their recent earnings report and outlook here.
Yeah.
And, sometimes these financial reports, they just look like numbers on a page, right?
Mm-hmm. Dry stuff.
But what if there's a deeper story? That's our mission today. We want to cut through those figures, understand what really drove Roper's, frankly, strong performance in Q2 2025.
Yeah.
And maybe figure out what it signals about their strategy moving forward.
Yeah.
It's pretty interesting how a company manages this across so many different areas.
It really is. And that's the value, right? Looking past just the headlines.
Exactly.
These reports, they give you a blueprint. Company health, a strategic direction, how different models actually drive growth. It's quite revealing if you dig in.
Okay, let's do that. Let's unpack this right away. Headline numbers, Q2 2025 for Roper. They didn't just meet expectations.
No.
They kind of crushed them. Earnings and revenue. So adjusted earnings per share, $4.87.
Right.
Now, if you're tracking this, the Zacks consensus estimate was $4.82. So they sailed past that.
And just quickly, that Zacks consensus, that's basically the average forecast from a bunch of independent analysts.
That's it. So beating it, that's a clear signal they outperformed what the pros expected. And that $4.87, that's a solid 9% increase year over year.
Mm-hmm. Solid growth. And what's really fascinating, I think, is how they got that top line. Net revenues, $1.94 billion.
Yeah, huge number.
Which, like you said, beat the consensus too, $1.93 billion. And that's up 13% from last year. But here's the interesting part, the mix.
Oh, that makes sense.
Yeah, it was like a really healthy balance. You had 7% organic growth. That's growth from their existing businesses, just doing better.
Okay, internal strength.
Exactly. But then you also had a 6% boost from acquisitions, new companies they brought in.
Right, so buying growth and growing from within.
Yeah, precisely. And that balance is, well, it's pretty critical. It tells you Roper isn't just buying its way to growth. They're actually nurturing it internally, too. That often signals, a more sustainable path.
Yeah, less risky maybe in the long run. That makes sense. Okay, so that balance is powerful. But, like you hinted, this is where it gets really interesting, right? Which parts of Roper are pulling the weight? When you look at the different segments, what stands out? Where are the real engine rooms?
Yeah, good question. Because this really shows the strategy, doesn't it? Roper has 3 main segments, and, well, each one did its part.
Okay.
First up, and you could argue this is the star, application software.
Application software, okay.
This thing generated $1.09 billion in revenue. That's over half the total, like 56.3%.
Wow.
And it grew massively, 17% year over year. That includes a strong 6% organic growth component, too.
So even the existing software businesses are growing nicely.
Yeah. Very nicely. And this isn't just their biggest segment. You get the feeling it's really their focus for the future. We're talking momentum from names like Deltek. They do software for government contractors, professional services.
Right, mission-critical stuff.
Exactly. Then PowerPlan for asset-heavy industries. Adderant for law firms. Vertafore for insurance. Big players in their niche.
Well, leaders in their fields, yeah.
And you see that pattern, high margin, often recurring revenue software. That's clearly a strategic choice.
Definitely looks like it. Okay, what's next?
Next is network software and systems. This one brought in $385.4 million, so roughly 20% of the total revenue.
Still significant.
Oh, yeah. Grew a solid 6% year over year, and 5% of that was organic growth.
Okay.
The drivers here, Construct Connect, that's a big platform for commercial construction info, and DAT Freight Matching trucking logistics software.
Dig, yeah, I know them.
Right. Plus, strengthen their healthcare businesses like SHP and SoftWriters. They do software for home health, long-term care pharmacies. Again, specialized, pretty sticky software.
Yeah. Sticky, meaning customers tend to stay with them.
Exactly. High switching costs, often deeply integrated. Okay, and the third segment. This one sometimes surprises people. Technology-enabled products.
Okay, so not just software.
Not just software. This segment pulled in $463.3 million. That's about 24% of the total revenue.
Nearly a quarter.
Yep. And sales were up a solid 10% year over year. But here's what's really impressive. 9% organic growth.
9%. For products, that's strong.
That's really strong internal growth for businesses that often combine hardware with software. The big performers here were Verathon. They make advanced medical devices like airway management tools.
Important stuff.
Very. And Neptune, they're a leader in smart water meters and systems. So it shows, they haven't abandoned their hardware roots entirely. They're just making it smarter, tech-enabled.
That makes sense. Integrating tech into physical products. Okay, so we've seen the revenue picture drilled into the segments. That software focus, but also strength in tech products. It's quite the mix.
It is. But let's shift gears a bit. How efficiently are they actually making money? What about margins, the balance sheet? What's the financial health story?
Right. The real test, isn't it? Top line is great, but how does it flow down?
Exactly.
Okay, so if we connect this to the bigger picture, profitability. Gross profit dollars went up nicely. 12.7% increase to about $1.35 billion.
A solid dollar increase.
Yeah. Now, the gross margin percentage did dip just a tiny bit from 69.5% last year to 69.2%. So 0.3%.
Barely noticeable. But the absolute profit grew.
That's the key takeaway. More profit dollars. Then you look at adjusted EBITDA. That's kind of like their core operational cash flow before financing and taxes and stuff.
Right, a measure of operational efficiency.
Exactly. That was strong, too. $775 million.
Okay.
12% year over year.
Nice growth there, too.
Yeah. Now, the EBITDA margin also dipped slightly by 60 basis points, so 0.6% down to 39.9%.
Okay, so margins trimmed just a hair, but profits and EBITDA dollars are growing well.
Precisely. We did see costs go up. Cost of sales, administrative expenses, both up about 14%. But that's pretty normal when you're growing, especially through acquisitions. The overall picture is still one of pretty efficient profit generation.
Okay, and the balance sheet, cash, debt.
Right, so cash. They ended Q2 with more cash than at the end of last year. $242.4 million versus $188.2 million back in December 2024.
Okay, building cash.
Building cash. Long-term debt did go up, though. It's now $7.86 billion, up from $6.58 billion at year-end 2024. Often happens with acquisitions, funding those deals.
True, but are they generating enough cash to handle that?
That's the crucial question, and the answer seems to be yes. Net cash from operations in the first half of 2025 was $932.8 million.
Wow, almost $1 billion in 6 months.
Yeah, and that's actually up slightly, 1.9% from the same period last year. So very strong cash generation. They spent a bit on capital expenditures, $26 million, investing back in the business.
Standard stuff.
And importantly for shareholders, they paid out $177.2 million in dividends in those 6 months. That's up over 10% from last year.
So growing the dividend, too.
Growing the dividend. So yeah, debt is up, but they seem to be generating plenty of cash to cover everything, fund growth, and reward shareholders. It looks pretty well managed.
Okay, that paints a pretty healthy financial picture alongside the growth. So what does this all mean looking ahead? They seem confident, right? They raised their outlook for 2025.
They did. Management's definitely signaling strength. They've bumped up their full-year projections.
Okay, what are the new numbers?
For 2025 adjusted earnings per share, they now expect $19 to $90 to $20 or SAF cents. That's nudged up slightly from the previous range.
Okay, tightening and raising the bottom end.
Exactly. Total revenues, they now expect to grow 13% for the year. That's up from 12% they thought earlier.
Another positive bump.
Yep. And organic revenue growth, they're now projecting 6% to 7% for the full year. Still very healthy.
Okay.
And just for the immediate next quarter, Q3, they're guiding for adjusted earnings between $5.08 and $5.12 per share.
So continued strength expected right away.
Looks like it. And, you layer on that Zacks rank #2, which is basically a buy rating from analysts. It all points to management feeling pretty good about the road ahead.
Yeah, that confidence seems well-founded based on these Q2 numbers. So for you, our listener, hopefully this deep dive shows that getting into these numbers isn't just, bean counting.
Definitely not.
It's about understanding the machine, right?
Yeah.
Seeing how a successful, pretty diverse tech company actually works, how the different pieces fit together, why certain strategies are clearly working for them.
Absolutely. When you analyze these specifics, you get so much more than just the headlines. You get a richer feel for the company's health, what's really driving growth, what the future might hold.
Yeah.
It's about seeing that strategy, the story behind all those numbers we just talked about.
Well said. What an impressive quarter from Roper Technologies when you really unpack it. It definitely shows how digging into these reports gives you a real shortcut to being, properly informed.
It really does. And maybe this raises a question for you to think about. How does Roper's whole strategy, this mix of diverse, high-performing software, these tech-enabled products, focusing on organic growth too. How does that position them, for resilience, for growth in a market that's always changing? And what does that tell us about what makes a successful business model today? Something to mull over.
That is a powerful question. Definitely food for thought. Thank you for joining us on this deep dive. Keep digging, keep asking questions, and continue your own quest for knowledge.